Gold and silver after the meltdown. Why the smart money is moving while the crowd panics. Something very strange is happening in the global financial system right now. While stock markets convulse, while trillions of dollars are erased in days, while headlines scream volatility, uncertainty, soft landings, and temporary dislocations, gold and silver are not crashing. They're not exploding either. They're doing something far more dangerous for the system. They're stabilizing. And history tells us this is exactly what happens before confidence in paper money begins to crack. Because when gold and silver stop reacting emotionally to chaos, it means only one thing: the smart money has already moved. Not loudly, not publicly, not with headlines, quietly. Today, we're going to break down what this historic market meltdown really means. Why gold and silver are behaving very differently this time. What central banks, governments, and institutions are quietly doing behind the scenes. And what this means for you, your savings, and your future purchasing power. This is not financial advice. This is financial reality. Let's begin. The meltdown they can't hide. The last major market shock didn't come with sirens. It didn't come with emergency press conferences. It didn't come with politicians standing behind podiums telling you everything is under control. It came quietly, disguised as normal volatility. But look closer. Bond markets froze, liquidity vanished, major institutions quietly reduced exposure, derivatives spiked, repo markets tightened, and most people didn't even notice. Because the modern financial system doesn't collapse with explosions anymore. It collapses with spreadsheets, with margin calls at 3 a.m., with temporary halts, with emergency liquidity facilities nobody votes on, with silent backstops from central banks that never make the evening news. The system doesn't scream, it whispers until it doesn't. And yet, underneath all of this chaos, gold and silver did not behave like speculative assets. They didn't dump violently. They didn't surge irrationally. They didn't trade like meme stocks or tech bubbles. They absorbed the shock. They stabilized. That alone should terrify policymakers. Because stability during chaos is not accidental. It's intentional. Why this time is different. In past crises, gold often sold off in the early stages. Why? Because when leverage collapses, everything gets sold to raise cash. Stocks, bonds, real estate, even gold. But this time, something changed. Gold and silver found buyers immediately. Not retail buyers, not panic-driven speculators, not social media traders chasing charts. Institutional buyers, central banks, sovereign wealth funds, large private wealth. The kind of money that doesn't chase hype. The kind of money that doesn't react emotionally. The kind of money that looks years ahead, not days. And this tells us something critical. Gold and silver are no longer being treated as insurance. They are being treated as core monetary assets again. That shift changes everything. Because insurance is optional, money is not. The death of trust in paper promises. Let's be brutally honest. Modern money is not backed by gold. It's not backed by productivity. It's not backed by discipline. It's backed by confidence. Confidence that governments will repay debt. Confidence that central banks can control inflation. Confidence that savings will hold value. Confidence that tomorrow will look like yesterday. That confidence is cracking, not exploding. Cracking. And cracks are far more dangerous than collapses because they spread silently. Every bailout erodes trust. Every emergency facility weakens credibility. Every temporary measure becomes permanent. Every promise requires another promise to support it. Gold doesn't need trust. Silver doesn't need belief. They don't promise anything. They don't depend on confidence. They simply are. And when trust disappears from a system built entirely on promises, reality steps back in. Central banks are telling you the truth without words. Ignore what central banks say. Watch what they do. Over the last few years, central banks have been net buyers of gold. Reserves are being diversified away from the dollar. Gold is being repatriated, not leased. Physical delivery matters again. Paper claims are quietly being questioned. Why? Because gold is outside the system. It has no counterparty risk. It cannot be sanctioned. It cannot be frozen. It cannot be printed. When central banks accumulate gold quietly, they are admitting something profound. They don't fully trust the system they created. they are hedging themselves. And if the architects of the monetary system are preparing for instability, what do you think that means for everyone else? Silver, the most misunderstood asset on Earth. Silver is not poor man's gold. That's a lie, a convenient lie. Silver is a monetary metal, an industrial metal, a strategic resource. It sits at the intersection of money, energy, technology, and defense. Silver is used in solar panels, electronics, medical equipment, military technology, EVs, data centers, and unlike gold, silver is consumed. Once it's used, it's gone, buried in landfills, locked inside electronics, lost forever. At the same time, above-ground silver inventories are thin. Mining supply struggles to keep up. New discoveries are rare. Demand keeps rising quietly. Silver doesn't need hype. It needs scarcity. And scarcity is exactly what's forming beneath the surface, not explosively, inevitably. Why stability is more scary than volatility? Most people think volatility is dangerous. It's not. Volatility is obvious. Volatility screams. Stability during chaos is what signals repositioning. When gold and silver stabilize after a meltdown, it means weak hands have exited, strong hands are accumulating. Price is being defended. Floors are being built quietly. That doesn't happen accidentally. It happens when long-term players step in. Players who don't need liquidity tomorrow. Players who don't trade headlines. Players who don't explain themselves. Retail investors only notice these moves after prices break away. By then, the repositioning is already complete. The psychology of the coming shift. Every monetary transition follows the same psychological arc. First, disbelief. Everything is fine. Then, confusion. Why aren't markets recovering properly? Then, anger. Why is everything more expensive? Then, acceptance. I should have protected myself earlier. Gold and silver don't spike at the start of crises. They spike at the loss of faith stage. When people stop believing official explanations. When savings no longer feel safe. When purchasing power erodes faster than wages rise. We are approaching that phase. Quietly. What this means for everyday people. Let's bring this back to real life. This isn't about getting rich. It's about not getting poorer silently. Inflation doesn't steal loudly. Currency debasement doesn't knock on your door. It erodes. Savings, pensions, fixed incomes, purchasing power, future choices. Gold and silver don't make you wealthy overnight. They help you survive monetary transitions. Every major currency reset in history included gold. None excluded it. Those who held real assets preserved purchasing power. Those who trusted paper, promises, learned too late. The final warning. The most dangerous words in finance are, "This time is different, but sometimes it really is." This time, debt levels are historic. Trust is fragile. Geopolitics are fractured. Monetary tools are exhausted. Confidence is thinning. Gold and silver are not reacting emotionally. They are positioning calmly, and calm positioning always comes before major moves. The quiet signal. The markets are screaming. Gold and silver are whispering. And whispers are often more important than screams. Because whispers are where truth hides. If you understand what's happening now, you're early. If you ignore it, you'll hear about it later. When the price is much higher and the choice is gone, this isn't about fear, it's about awareness. And awareness is the most valuable asset of all. Stay awake. Stay aware. This is Felix. See you next time.